All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and I wanted to get a video out here today walking you through some of the tips that we find very beneficial for navigating through a very volatile environment or even a bearish market. We have seen volatility really return in a big way for most of this year, but it's really intensified over the past few weeks, and it makes perfect sense, right? Coming into this year, we were right up near all-time highs. The market was basically brushing aside all bad news and trading off of the hopes of further stimulus, and the Fed and central banks worldwide doing everything in their power to prop things up. Now we've seen that all change, right? All of that stimulus has some consequences, and we're seeing that now because inflation out of control, right? Now the Fed's trying to play catch up. They just raised rates again this week, another 3/4 of a point with no end in sight. They're going to continue to raise rates in the months to come. And that's a big headwind for the market because now they're raising rates in the face of a slowing market, of a slowing economy. Not a great combination, right? You also have the continued uncertainty with Russia, Ukraine, potential for food shortages later in the year. We have the upcoming midterm elections. I don't say all this to scare you away from the market, but we're all seeing the same headlines. What I'm trying to show is it does not matter what the headlines are stating. There is money to be made as long as you can take a few key steps, which I'll talk about here today. I'll walk you through some of the markets that are on our radar for next week and talk through how we're structuring our options trades in this uncertain environment. So when we take a look at the daily chart, let's just start out here and let's just take a look at a technical perspective, because if we take a look at the news, we can all go through a whole list of headlines that could scare people away from the market. And CNBC, Bloomberg, Fox Business, they're all doing a good job of trying to do that, right? They're trying to get everybody out of the market. They're trying to scare you into cash because of the unknowns. Is there going to be a market crash? Is there going to be an extended bearish downturn? Well, as traders, we have to realize that there's opportunity regardless of what the market's doing. If you're a long-term investor, it's a different story. It may be a bumpy road in the months and years to come if you're a long-term investor. But for us as active traders, we actually thrive in these periods of volatility. We love the movement back and forth. And I'll show you some results here in just a moment that backs up what we have said now for years. There is more money to be made on the downside than the upside. Everybody gets so enamored with the never-ending bullish market when in reality, it gets more exciting for us as traders on the downside. So from a technical perspective, you can see we had this sideways pattern going back a couple of weeks. This is a daily chart of the S&P 500 ETF. And we had this sideways pattern. It's what we call the coiled spring pattern, right? We had that sideways move. It was back, forth, seemingly on a daily basis. And it is the market's way of building energy for the next move. We know long-term, the S&P doesn't like to stay quiet for long. In this sideways stretch, we were building energy for that next move. It was that coiled spring coiling tighter and tighter. At some point, it's going to pop. We just don't know when that's going to happen, nor do we know in which direction it's going to happen in. Finally, we got some clarity here over the last 2 weeks because we did see this break to the downside, and we see some pretty good follow-through. It's been pretty nasty here over the past week and a half. That leaves us with some very oversold conditions in the near term. There's a lot of talk right now. We're hearing it from our members. We're hearing it from people that are coming to us looking for help with their trading. People say, like, this market's going to fall apart. This market's going to crash. Well, my pushback to that is no one knows what's going to happen day to day, week to week, or even month to month. We have to take what the market's giving us, and we have to be open to trades in both directions. What is the first tip for getting through a bearish market? You have to keep an open mind for trades in both directions. If you take a look at the market out 6 months and say, this market, there's so many headwinds, I don't see how this market can move higher. And if you only focus on one direction, say, I'm only going to be bearish in the market, you might miss out on some tremendous opportunities in the near term. Because in bearish markets, you're going to see the bear market rallies. You're going to see those oversold conditions met with a round of buying. You get the short covering added in, and you can get some pretty massive moves to the upside. Now, when I talk about putting on a bullish trade right now, I'm looking at what's going to happen over the next few days on out to the next week. Could I play the upside here? Could I play for a bearish rally, bear market rally here going into next week and still be bearish on the market long term? Sure. We can take trades in both directions, right? I could very well see the market trying to get up to this 8-period exponential moving average. That's that pink line on my chart right above 380.50. Now, it could be a combination between price bouncing higher and this moving average, because it's such a short-term moving average, it's going to continue to move lower into next week. We could see price move higher, the moving average move lower, and they meet somewhere potentially just below 380. And that would be a first area of resistance. What that would do for us is potentially give us the chance to play that bounce to the upside, but would also reset for another wave to the downside. At that point, I would be more interested in some bearish trades because we've seen a bounce. We've worked off some of that oversold excess. right? Chasing now, putting on bearish positions now, guys, today, after what, 7, 8 days on the downside, you're chasing at this point. The odds are not in your favor. It doesn't mean the market can't move lower. It just means that we're overdone in the near term, probably due for some relief. Wait for a potential bounce first before you get aggressive on the downside. If you're already in bearish positions, maybe you did get bearish on this move to the downside, you can certainly hold some of those positions into next week, but move those stops down, lock in profit. Don't shoot for the moon here at this point, right? Don't be a hero. Those small profits, those partial profits can add up in a big way. And I'll talk about that more in just a bit. So going into next week, looking for a potential bounce into the 8 EMA. On the downside, should we reverse back to the downside? The low of the session today at 362.17, that's our near-term area of support. Below that, we'd be looking at 361, 360 and a half, and 360. I'm simply looking at the 0.50 levels and the 0.00 levels, the big round numbers below us, as potential support areas to keep an eye on. The volume has been phenomenal here the last few weeks. Well above 100 million shares on SPY have been trading on a daily basis. That's great. Definitely makes it easier for us to get fills on trades. The ATR down at the bottom, that's the average true range, and it's back above 10. When I start to see an ATR above 10, it's indicating that there's a really big range throughout the day, during the day, and it turns into more of a day trading environment. That's an environment where I typically want to be in and out of trades much quicker. Now, the way that I trade options, I'm not looking to day trade. I'm looking to swing trade. I'm looking to hold for a period of a couple of days and out to a couple of weeks. But when the ATR gets above 10, I'm typically looking for those in and out type trades. You hold too long, you overstay your welcome in this market, it can get painful in a hurry, right? So being open to different types of trading, long term, I love to be in positions, 10, 20, 30 days. But in this type of a market, taking what the market's given us, I have to be okay getting in and out in 1 to 3 days, right? Being flexible, another key to get through this market. Now, I talked about some of the results because again, with volatility, take a look at the VIX, it's above 30. If I take a look at the daily chart of the VIX, you can see we're near the upper end of the range that we have seen over the past year. You can extend it back even further. We're near an upper end where typically fear starts to subside a little bit, starts to pull back. I wouldn't be surprised if we continue to see that pullback. Fear is often overstated. It's been overstated now for the last couple of weeks. We'll see if we start to get volatility to contract a bit. Now, when you start to see this period of high volatility, this right here, what we've seen recently, if we go back into April, if we go back into February, into January, if you take a look at all of these spikes, look what happened shortly thereafter. During all these spikes, this is when the media is trying to scare you away, saying, hey, the market crash is coming. Get out of the market, get into cash. Look what's happened every single time. We get a spike, volatility contracts. We get another spike, volatility contracts, right? Is this the once in a lifetime market crash? If you're playing for that, guys, it's going to be a very difficult game long term, right? The market's been around for decades. It's going to be around for decades to come. Are we going to see big moves back and forth? Sure. But instead of trying to play for those black swan type events, be open to trades in both directions. There's far more money to be made if you can be open to getting in and out of trades in a shorter duration rather than just buying or selling and hoping for a big once in a lifetime move. All right. So here's what that's looked like. Now, I'm not showing you these results and say, wow, look what we've done and to pat myself on the back. I'm showing you these simply because I want to show you what can happen with these short-term strategies. What can happen as long as you use a defined rule set, stay very disciplined to your risk rules. This is what can happen in periods of volatility. I mentioned earlier, some of our best stretches have come during the moves to the downside. Bear markets present a tremendous opportunity because people panic. Things happen much quicker. Here's our Nasdaq service. If we take a look at the numbers and just go back to when volatility started to really pick up here recently, right? If we take a look at the Nasdaq trades, we've had 13 wins and 2 losses out of our last 15 trades. Is that a reason to go to the sidelines? Is that a reason to pay attention to financial media and say, look, cancel me out of everything. I don't want anything to do with this market. No, there's tremendous opportunity here. Now, another key point to make. We mentioned earlier, one of our first tips is being open to trades in both directions. Don't fall in love with one side. Don't be that perma-bull or perma-bear. As good as things looked last year, okay, you can clearly see what happens when things normalize here this year. As bad as things look right now, this market getting beat up this week, it's not as bad as you think. There's always opportunity in both directions. Second point here, second tip. Size can kill in this market, guys. Where so many people get hurt is they're trading too big, right? You take a look at the crypto traders. Look what's happened to the cryptocurrency markets. Really the last couple of months, but most recently, they have been crushed. The reason why people are getting hurt so badly is there was a lot of newer traders in the crypto markets. They're trading too big, hoping for that once in a lifetime, just hit it big and it changes your life type event, right? The problem with that, guys, is if you trade too big and you risk too much, if you get on the wrong side of that move, it can get painful in a hurry. Next thing you know, your account's down by 50, 75, 90%, or maybe you've even wiped out an account and you're saying, what just happened? Don't fall into that trap. Okay. If you can keep your risk between 2 and 5% of your account, that's what we train our members to do. If you can take that approach, you can keep the risk small. You can manage the risk when those trades go against you. You're not going to wipe out an account because long-term, we know we're going to have winners and losers. That's part of trading with any market, with any system, with any time frame. It's going to happen 100%. If we can keep those losses small, we can battle back much quicker. We're not going to be playing Monday morning quarterback, looking at a blown out account saying, if I would have done this, I would have still had capital to trade with. Take those risk rules, put those in place immediately before you take another trade. So if we take a look, am I looking for home run type trades? I mentioned earlier, this is not the environment, in my opinion, to swing for the fences. But can I take a look at, 21%, 24%, 28%, 18%? Can I take a look at a 20% return on my capital in a matter of a few days? Guys, that's big. Take a look at how many horror stories are out there right now of people just getting crushed in this market, and we're sitting here building that account, right? Now, all of these numbers here, these reflect taking trades with very small positions. Right? I'm just trying to give you the minimum numbers. You can certainly take these trades with multiple contracts and multiple spreads, and it starts to get really exciting. Here's our Simplified Options Superstars program. This is the one that focuses on trading long calls and long puts. And if I scroll down here, just take a look, since volatility started to expand, is there a reason to go to the sidelines? Is there a reason to be afraid of this market? No, look at the simplified service. We've had 23 winners and 2 losses in the last 25 trades. Is there money to be made here? Absolutely. If you get caught up paying attention to financial media, you're missing out on potentially thousands of dollars of profit. Again, all of these trades, average cost per trade, $300 or less per contract. If you've got a bigger account, you can do some simple math here. Just start to multiply, right? You start to risk, $1,000 per trade. You start to take 2 or 3 contracts. These numbers get significant, right? Is this a reason to go to the sidelines? Absolutely not. If I go to our ETF Options Superstars program, this one very similar to our Nasdaq service in that we use a mix of trade types. We use some long calls and long puts, but we use a lot of vertical spreads as well. This one here, 37 wins and 2 losses going back over the past few months. Again, you're talking about thousands of dollars of profit that you're potentially missing out on if you go to the sidelines. All of these trades here, and we're talking about average cost in these trades, a couple $100. Do I have to load the boat? Do I have to get aggressive? No, I don't, nor do I want to. Size kills in this market. When the volatility gets amped up, you can still stay active, manage that risk. Keep that risk between 2 and 5% of your account, and you are definitely going to be better off. Now, what I showed you with those 3 services, the Nasdaq, the ETF, the Simplified Options Superstars program, those are all using a mix of trade types, right? So if I take a look, I'm using some long calls and long puts. I'm using some debit spreads. I'm using some credit spreads. I'm also using some weekly options. I'm using some monthly options. Another tip here, diversification. You have to stay diversified in this market, not just with the markets that you trade. That's a big part of it. We want a mix of different stocks and ETFs and different sectors. But I also want to mix up my trade types. The long calls and long puts, they're great. They can provide some big returns, but you need the market to move in your favor to make money. The credit spreads, the vertical spreads, they allow us to get a more forgiving trade. I give myself 5 ways of making money on those trades. It takes less capital to put them on. Now, I am giving up my home run profit potential, but I'm starting to add in different layers of diversification. So now, if the market does fall out of bed, I'm positioned for that. If we just kind of chop here, if we start to consolidate and build energy for the next move, there's things I can do to make money inside of that consolidation. Or if the market bounces higher, I want to be able to react to anything the market throws our way. If you take a look at these spreadsheets, it's a mix of bullish and bearish trades. What I'm not going to do is to come in and say, hey, this market, all the news is bad. Market's headed, or the economy's headed for a recession. The market's heading for a breakdown. Let's just get 100% bearish. Guys, everybody is bearish right now. What happens when everybody gets loaded on one side? Everybody was all bullish towards the end of last year. What happened? The market threw everybody a curveball here to start the year, and it's been a pretty nasty start. When the boat gets loaded in one direction, where everybody has the same outlook, everybody has the same opinion, that should be a warning signal. Okay, the market likes to throw everybody a curveball right now with everybody bearish. I wouldn't be surprised at all if we get one of those nasty rip your face off type rallies. The market likes to surprise everybody. Is it sustainable? Am I saying the bottom is in and the market's going to rally higher for the rest of the year? No, not at all. But in the near term, being open to trades in both directions, it makes a huge difference. So all we're doing, guys, we're not reinventing the wheel. We're looking at this market saying, let's block out the news. Let's block out all the headlines. Let's not get worried about that. Let's take what the market's giving us, right? Be open to trades in both directions. Keep that risk small and diversify with different types of trades and different types of options. If you can do that, there is tremendous opportunity. I'm showing you these are real results. These are trades that we've taken with our members that are part of our signal services. Here, I'm not hiding the losses here. You can see the red lines here. We've had some losses, but we're winning far more than we're losing, and we're in a really great stretch. One of the worst stretches that we've seen in this market in years, and yet we're seeing profit levels that are just continuing to build. That's a powerful combination. So what does that mean for us going into next week? How do we apply what we just talked about? Some of those key points that we just talked through. Let me walk you through. Let's jump over to a chart of Amazon. This is what we call our weekly gems approach. It's utilizing an hourly based chart. And what I'm looking for, ideally, I want to see markets hit an extreme and then start to reverse in the other direction. I have my pink channel here on the chart. What I'm looking for out of this hourly setup, ideally, I want to see price close above our upper pink channel. If we can get a close this afternoon or even early next week, that would allow me to come in and sell an out of the money put spread. Selling a put spread is a neutral to bullish position that would benefit from the stock either continuing to move sideways, which it has done over the past week, or potentially bounce to the upside. The market decides to bounce off of these oversold conditions, we could very well look at a really nice profitable trade on the upside. The hourly based chart, the weekly gems approach is looking for a typical holding time of 24 hours on out to 3 or 4 days. Looking for very quick in and out trades. These are not buy and hold type trades for weeks on end. We're looking to get in and out very, very quickly. So if Amazon ends up closing above our upper pink channel, what I would be looking at, if I jump over to the trade page, I would be taking a look at the June 24 weekly options. Those are the ones that have 7 days left. They expire next Friday, right? What I did is I went to the out of the money puts and I went to the 102.5 puts. They're about $2.50 out of the money. The stock's trading for 105 now. If I sell the 102.5 put and then buy the 101 put, it's a fully risk-defined trade that gives me a neutral to bullish position. In this case, I would want Amazon to stay above 102.5. I don't need a huge move to the upside. All I need it to do is to stay above 102.5 and I can make money. Up, down, or sideways, I don't care. As long as it stays above 102.5, I'm good to go. I also make money from time decay adding up and from volatility decreasing. If I collect 45, that's kind of bouncing around between 44 and 45 cents. Let's say I can collect 45 cents here. I would be risking 105 to make 45. I'm right around risk 2 to make 1. Why am I okay with that ratio? I'm okay because I do have those 5 ways of making money on the position. It's going to be a very high probability trade. Okay, having 5 ways of making money on the trade, it's in this type of a market, you're not asking for everything to line up perfectly. We have a little bit of wiggle room. The stock is trading for 105. I make money as long as the stock stays above 102 and a half. So I have a little bit of a cushion here. This stock could continue to move to the downside by a few bucks and I'm okay. The only move that hurts me is a big move to the downside, which we're not expecting because the stock in the overall market, for that matter, is so oversold. All right. So if I go like 45 cents, it's $45 per spread. That's my max profit. You're looking at saying, well, it's not a ton of profit, Mike. But remember, I only tied up $100 to begin with, and I give myself those 5 ways of making money. You could put this trade on 10 times and still only have $1,000 of risk. Now you put it on 10 times, you have $450 of profit potential over the next 7 days if the stock doesn't do much of anything. Remember, taking what the market's giving us, controlling our risk, it can add up in a big, big way. Is this the only trade I'm looking at for next week on Amazon? No, it's one trade in our toolbox. What I ideally want to do is take 6, 7, 8 very small positions so I can spread that capital into many different areas, get that diversification that we talked about. Right now, if I get filled at 45 cents on this trade going into next week, I would look to close it out for between 11 and 22 cents. Why? Because that would allow me to keep between 50 and 75% of the max profit. In this market, remember, I don't want to overstay my welcome. I want to get in and out as quickly as possible. So if we get any type of a push to the upside going into next week, book the profit as soon as possible, free up that capital and move on to the next trade. Stay as nimble as possible while the volatility is staying elevated. Now, the reason I love the credit spread also is markets are closed on Monday. We have a long weekend here upcoming. The time decay does not pause for the weekend. Those of you that are newer to trading options, options lose value every day that you hold them. Not a big deal as long as you get a directional move in your favor, or if you're selling a credit spread like this, every day that passes, that option losing value, that helps me. It helps me make money. The goal is for me to buy this spread back cheaper next week. Anything to cause the stock to get cheaper is to my benefit. Whether it's a directional move to the upside, if it's time decay adding up, or if it's volatility decreasing. Any of those three would help me make money, right? So pretty powerful approach. We have a long weekend. Markets are closed on Monday. Guess what? That time decay is still adding up. It's adding up Saturday, Sunday, Monday. So now the market being closed is actually helping on this position. So it's a neutral to bullish trade here on Amazon. I wouldn't put the trade on here immediately. At the time of this video, it's just before noon Eastern time. I don't like to place new trades right midday like this because in this market, anything can happen. I'd rather wait for that last hour of the day, come and see if we can get filled at a better price and try to avoid any type of intraday chop that we see develop. Now, one last trade that I want to talk through, let's take a look at a long call option. Again, I want to trade a mix of strategies. I do love to trade a lot of credit spreads because they are so forgiving, but there is a time and a place for the long calls and long puts. And if we take a look at this market, if we expect the market to continue to be very active, there's definitely room here to put on some more aggressive type trades. Not going to fall in love with one direction in the overall market. I'm not going to fall in love with one trade type. Getting that mix of trade types, giving a mix of bullish and bearish trades, it makes a huge difference over time. So here's Chewy. This is Chewy.com, symbol CHWY. It's on the 130-minute chart, and you'll see my blue dots here over on the right. Once my blue dots are hit, which happened here earlier in the week, we came in and we put on a bullish trade. Now, putting on a bullish trade could look a couple of different ways. Could we come in and just buy a long call? Sure. Could I sell a put spread? Sure. They're both bullish. In this case, I put on a long call. Okay, again, mixing up my trades. We already talked about Amazon being a credit spread. We've already put on a handful of credit spreads this week. So I want to mix it up a bit. My entry point at my blue dot was at 28.87. Okay, that level was hit here this week, and we're actually still sitting right around that entry point. My target is up at 33.29, and my stop is down at 27.61. It's a pretty tight stop, right? I really like this setup if the market decides to bounce going into next week. So what we did on this trade, we put on a bullish long call position. We went out into the July monthly options, and we decided to buy the 30 calls. These options are right here. They're now trading for just over $2. You're going to spend just over $200 per contract to put on a bullish trade that would benefit from any type of a push to the upside. If this market does bounce, again, I'm not expecting a sustainable bounce back up to the highs, but in the near term for the next couple of days, very well could see that bear market rally. If that happens, great. That call option will increase in value pretty quickly. Worst case, if I am dead wrong, worst case, if I hold all the way up to expiration 28 days from now and this stock completely falls out of bed, the most I can lose is just over $200 per contract. And I can always close out of the trade early before expiration and take a partial loss. Remember, on my chart, if I can get to the right chart here, as soon as this stop is hit at 27.61, we'd be out of the trade and we can take a partial loss. So limited risk, pretty nice profit potential. That's a nice scenario, right? So what I'm trying to do here, Amazon, Chewy, they're different products, right? They have very different characteristics in how the stocks trade. I'm looking at a credit spread on Amazon. I'm taking a look at a long call on Chewy. I'm starting to mix up my trades, right? I'm keeping my risk between 2 and 5% of my account per trade, and I'm giving myself the ability to make money regardless of what the market does. So if you have questions on any of these tips that we talked about here today or any of these trades that we reviewed here, let me know. I'd love to connect. You can leave a comment on the video or send me an email to mike@netpicks.com. If you have not subscribed to the channel yet, click the subscribe button. We'd love to have you follow us in our upcoming videos, and I'll update you on both of these trades here going into next week. I'll jump back on for another video. So guys, stay safe, be cautious in this market. There's a tremendous opportunity here as long as you follow some of the tips that we talked through today and have that discipline plan in place that you can follow. So hopefully you found this beneficial. I'm going to wrap this video up here and I'll jump back on here next week for our next video. We'll talk to you then.